Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session. In today's session, we are going to discuss two very important RBI notifications, two very important news articles that are quite in news recently. So the first one is regarding the RBI has asked the banks to assign additional 2.5% buffer rate on the digitally enabled deposits. So we will discuss that what is this extra buffers that the banks have to keep, what were the previous limits and what is the new limit, and what are the changes that the RBI has discussed in the LCR. Okay, so that we are going to discuss, and we are going to discuss the terminologies that are involved. The second news article is regarding the bank.in. So it has been said by the Reserve Bank of India in its notification that it has to be the bank.in, this domain has to be adopted by the banks by October 31st 2025, and there is an entity that will be the exclusive registrar. So all of this we are going to discuss in today's session. Okay, so good morning to all of you and welcome to the session. I hope you have understood that these two news articles, they are the RBI notifications also, and they are very important from the examination perspective, from the objective perspective. So let's get started, but before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join the Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Okay, so let's start with the first news article, that is the Basel III framework on liquidity standards. Liquidity coverage ratio. So there is a review of haircuts on the high quality liquid assets and runoff rates on certain categories of deposits. So it might seem very complicated as there are various new terms that you might see here. Okay, but do not worry about it. As we go forward in the session, one by one you will understand all these important terminologies. Okay, so first of all, why this review has happened? The review has happened. There is some change that the RBI has brought. So why this review has happened? Why the RBI has brought a change? So first of all, try to understand this, that the banking has undergone rapid transformation in the recent years. You can understand that in 2016, there was the adoption of the UPI system. There is the RTGS and the NEFT. That is becoming more and more popular. The internet banking, the mobile banking is becoming more and more popular, and the people, they are doing more and more digital transaction. Like I can remember that there was a time that I was keeping cash with myself, that okay, I have to pay at some place, so I will be able to pay. But right now at many of the places I do not carry cash because I have become so habitual that I do not find the need to carry the cash. Similarly, I have many people around me that do not carry cash as much. So you can understand that we have become habituated of this digital transactions, of this online transactions. Okay, and with the advent of so many of the systems that we have around us, the banking has undergone rapid transformation in recent years. There is the increased usage of technology. This has facilitated the ability to make instantaneous bank transfers and withdrawals. Okay, so if you want to transfer the money to any relative, if you want to transfer the money to the merchant, if you want to transfer the money to anyone, you are able to do it very easily. The withdrawals, the ATMs, the number of ATMs in the country has increased. There are the white label ATMs. That if the bank ATMs, they are not able to reach to far off areas and such, or if the bank ATMs are not sufficient, there is also the white label ATMs that is run by the non-bank entities, so that the number of ATMs have increased in the country also. So it has made the withdrawals and transfers very easy. The UPI, RTGS, NEFT system, internet banking, mobile banking, it has made the transfers very easily. Okay, the withdrawals of the money has also become very easy. Now, this is for the ease of the people, right? The ease of customer has increased. The ease of customers, it has increased. The ease of people, the ease of public has increased. But do you think that this is without any problem? Or with the increased ease of the public, is there no problem that is coming? No, there is a problem that is coming. The risk is also increasing. Okay, so it has also led to the increase in risk requiring proactive management. So what is the risk that is increasing? Actually, try to think about it, that let's say there is a XYZ bank, and suddenly there is a news that comes that okay, this XYZ bank is under the stress. this XYZ bank is under the stress, there is a accounting discrepancy that has been found, or there is the liquidity crunch that is coming in this bank. As soon as you hear this news that okay, the bank is in problem, I have my account in this bank, my relatives have the account in this bank, the neighbors have the account in this bank, so you will call everyone and you will ask them to take the money out from this bank because this bank might close down soon. So many of the people, they start withdrawing their money from this bank, and it is very easy to withdraw the money from the bank. You can just do UPI. You can transfer the money from one bank account to another bank account of yours through the UPI system, through the RTGS system, through the NEFT system, in which instantly the money can be transferred. Okay, so the entities, the retail depositors, the wholesale depositors, so they can easily take out their money, or they can easily withdraw the money, or they can easily transfer the money from one bank account in a bank to another bank account in another bank. So you can understand that this bank that was undergoing a stress, that was undergoing the liquidity crunch, is now facing the problem that many of the depositors are taking out their money. So the bank requires further liquidity, but the bank was already under the liquidity crunch. So it creates a problem for the banks, and that's why there is a proactive management that is required. Because of the internet banking, because of the mobile banking, because of the UPI system and such, it is easier to transfer the money, it is easier to withdraw the money now. Okay, and this can lead the problems for the bank, especially if the bank is already in a stress situation. So many of the depositors might lose trust on the bank, and they might start withdrawing the money in a very fast manner. Before, it used to take time. Before the, let's say, before the advent of the UPI, before the RTGS and NEFT was so popular, so if the XYZ bank was in the stressful situation, or there was any problem that was coming, there was liquidity crunch that was present in the XYZ bank, so the people used to go to the XYZ bank and they used to stand in lines, and then they used to take out the money, and the bank could say to the depositors that okay, there is no problem, there is no worries, and the bank could interact with the customers. The bank can make the customers understand that okay, you don't have to worry. Okay, the people, they were actually going to the bank physically to take out their money, but now it has become so easy through the digital transactions, it has become so easy to take out the money. Okay, so this is a problem. Now, in regards to this problem, there were the directions that were the draft guidelines that were released. Okay, in the draft guidelines, you can understand that the Basel III framework on liquidity standards, liquidity coverage ratio. So draft guidelines were released regarding the liquidity coverage ratio in July 2024, and now after the feedback has been taken from the stakeholders, the final guidelines have been released, and we will discuss that what are these final guidelines. Okay, but before that, let's understand the Basel III, because it is regarding the Basel III framework. So Basel III is an internationally agreed set of measures developed by Basel Committee on Banking Supervision. So Basel Committee on Banking Supervision, it developed the measures, that is Basel III measures. Okay, the Basel III is an internationally agreed set of measures that is developed by the BCBS, that is Basel Committee on Banking Supervision, in response to the financial crisis that happened, that started from US and it spread to the other parts of the world, and it came to be known as the Great Recession. The Great Recession. So you can understand that there was Great Recession that started from US, because in US there was a subprime mortgage crisis. So in US there was a subprime mortgage crisis that started in 2007, and this spread to the other parts of the world, and it came to be known as the Great Recession. It was a very huge financial crisis. Okay, so after the financial crisis of 2007-2009, the Basel Committee on Banking Supervision, it prepared the internationally agreed measures, that is Basel III. The measures aim to strengthen the regulation, supervision, risk management of the banks. So the Basel III, it is focused on the strengthening of the regulation, supervision and risk management of the banks, and it lays down some minimum criteria that okay, the bank should have this much minimum capital to risk weighted asset ratio, the bank should have this much minimum liquidity coverage ratio, the bank should have this much of the minimum. So the basic minimum criteria or limits are set by the Basel III. Okay, like all Basel Committee standards, Basel III standards are minimum requirements. There are certain minimum requirements which apply to internationally active bank. Okay, and the regulatory authorities, the domestic regulatory authorities. Like in the case of India, the Reserve Bank of India is the domestic regulatory authority on the banks. Okay, so the Basel III has determined or has said some minimum, has laid down some minimum criteria or some minimum requirements. The RBI can like lay down the requirements at a higher rate but not lower rate. Okay, so let's say the minimum CRAR has been set by the Basel III. Basel III has said that this should be the minimum CRAR. Okay, now the RBI can keeping in mind the minimum CRAR laid down by the Basel III, the RBI can tell a higher minimum CRAR but not lower. So this is the Basel III standards. They are the minimum requirements which apply to internationally active banks, and members are committed to implementing and applying the standards in their jurisdiction. And the regulators in their respective jurisdictions, they follow this minimum requirement. They can they can keep the higher minimum requirement but not lower. Okay, so this is the idea. So I hope this is very much clear. The Basel III, this is an internationally agreed set of measures. Now under the Basel III framework on the liquidity standards, there is the liquidity coverage ratio. That is very, very important, that we have to understand now. So as you know, banking has undergone rapid transformation and the people can take out their money pretty easily now. Okay, so the LCR, first of all, LCR is what? It is the liquidity coverage ratio. So for that you have to understand the total net cash outflows over 30 days. So banks, they have to estimate that what is the net cash outflows that they are going to face in the next 30 days in over 30 days. Okay, so net cash outflows means that how much is the net withdrawals, how much is the net cash withdrawals that is going to happen over next 30 days. Okay, now against this net cash outflow over the 30 days, the banks have to maintain the stock of high quality liquid asset in the form of cash, in the form of government securities, or in the form of sovereign securities and such. Okay, so basically the idea is that against the net cash outflows over the 30 days time period, that in the next 30 days, how much is the expected net cash outflow, on the basis of that the banks keep some high quality liquid asset in the form of cash, in the form of government securities, sovereign securities, and the examples or the high quality liquid assets we are going to see in the coming slide. But this is the basic idea, that against the total net cash withdrawals or against the total net cash outflows over the next 30 days, let's say bank is expecting the net cash outflows to be 100 crores in the next 30 days. Okay, so against that the banks have to keep the stock of high quality liquid asset in the form of cash, in the form of government securities, other securities and such. Okay, now this should be 100%, this should be 100%, that is if the total net cash outflow in the next 30 days is 100 crores, so stock of high quality liquid assets should also be 100 crores, should also be 100 crores or more than 100 crores. That's why the liquidity coverage ratio should be equal to or greater than 100%. If the total net cash outflow of the bank over the 30-day time period is going to be 100 crores, so the stock of high quality liquid asset, the stock of high quality liquid asset that the bank is keeping should also be 100 crores or more than 100 crores. Okay, so there should be 100% coverage of the net cash outflows over the 30-day time period that the bank is keeping. This is the liquidity coverage ratio. So the existing liquidity coverage ratio framework for banks in India has been reviewed in the light of recent developments. So you can understand that it has become very easy to take out money from the banks. Okay, from the banks, if we feel that okay, this bank is under the stress and we have the bank account in this bank, we have the deposits in this bank, and we are afraid that what if this bank closes down and our money is getting stuck, even though the money is like till the deposit of 5 lakh, the money is secured or the money is insured by the DICGC, but still many people can get afraid that okay, who will go to DICGC, what is the process, we don't know about it. So the people might get afraid and they might start taking out their money when the bank is working, because they know that the bank is under stress, the bank is under the liquidity crunch. So the people will start taking out the money and the net cash outflows over the 30-day time period will increase, and the stock of high quality liquid asset might be low with the bank. So this can create a very big problem because of the internet banking, because of the mobile banking, because of the different technologies that we have now, because of the different digital ecosystem that we have now. We can take out the money very easily. The net cash outflows can increase pretty easily for any bank. So this is a kind of problem or risk for the banks, and that has to be catered to. Okay. So the existing LCR framework for banks in India has been reviewed in light of the recent developments that has happened in the technological sphere, in the digital ecosystem sphere. Okay. The feedback has been received, has been carefully analyzed, and it has been decided to issue the final guidelines. So the draft guidelines were released in July 2024. After that, the feedback was taken from the stakeholders, from the market participants, and now the final guidelines have been released. That we have to understand. So any confusion anyone has till now? I hope there is no confusion. Moving forward, so let's understand the final guidelines. Okay. A bank shall assign an additional 2.5% runoff factor for retail deposits. First of all, what is a runoff factor? Runoff factor is money is running out, simply. Runoff factor means money is running out. Okay. So let's say that you have an account and the bank is expecting, you have an account in which you have 4 lakh rupees. Now the bank is expecting that you will be taking out around 40,000 rupees in the stress situation. So that means you have a runoff factor of, let's say, 10%. Okay. So this is the runoff factor, that how much money will you withdraw during the stress situation. So a runoff factor represents the percentage of deposits expected to run off, that is to be withdrawn. So runoff factor represents the percentage of deposits expected to run off or to be withdrawn during a period of stress. A higher runoff factor, let's say you will be taking out 80,000 rupees. That means 20% is the runoff factor. So the higher the runoff factor, the higher is the problem for the bank, because more will be the withdrawals during the stressful situation. Okay. So the higher the runoff factor means the deposit is seen as less stable and there will be more withdrawals that will happen, and the bank must hold more liquid assets against it. Okay. So a bank shall assign an additional 2.5% runoff factor for retail deposits. Try to understand this. Just see this, you will be able to understand. So current runoff factors for stable retail deposits is 5%. If it is a stable retail deposits means that the retail deposits done by the people that have a long-term relationship with the bank, that have a long-term trust on the bank. Okay. So like the pensioners, the salaried employees and such, so they have kept their money with the bank for a long period of time, and seeing the previous history of these people, it is seen that they do not take out the money very like on the regular basis, or they do not take out huge amounts of money. Okay. So stable retail deposits, these are the stable retail deposits, and their runoff factor is taken at 5%. So that means if you have a deposit of 1 lakh rupees and you have a stable retail deposit, or your retail deposit is considered stable by the bank, so you will have a 5% runoff factor. That means during the stress, it is expected that you will only take out 5,000 rupees. Okay. Now less stable retail deposits. Less stable retail deposits means that they do not have the long-term history with the banks. They do not have the long-term relationship with the banks. So in this case, and it has been seen that in the previous time period, these people have taken out the money on the like on the basis that sometimes they are taking out more money, sometimes they are taking out like less money, sometimes they are just emptying their whole account and such. So in this case, less stable retail deposits, as per the previous history of the deposits, it is seen that which accounts or which deposits are less stable, and for that the runoff factor is kept at 10%. Okay. So this is the idea. Now with the internet and mobile banking, being enabled, let's say in some accounts there is the internet and mobile banking that is enabled. Okay. So if the internet and mobile banking is enabled, you can understand that during the stressful situation, these people are more likely, and it is more easier for them to take out the money from the accounts. Okay. So the revised runoff factors, so there is the revision that has been done on the runoff factors for deposits enabled with internet and mobile banking. So even if it is stable deposits, but it has enabled internet and mobile banking, so there is additional 2.5% of runoff factor that is present for these kind of stable deposits that is enabled with the internet and mobile banking. Let's say, so in total, it will have 7.5% of the runoff factor. In the case of less stable deposits, it has the runoff factor of 10%. But let's say the less stable deposits, they are enabled with the internet and mobile banking, so they will have the additional runoff factor of 2.5%. So basically a bank shall assign an additional 2.5% of runoff factor for the retail deposits which are enabled with the internet and mobile banking. As easy as that. So stable retail deposits, they usually have the runoff factor of 5% because they are considered stable deposits. They have a long history with the banks, the accounts have the long history with the banks, the customer have the long history with the banks, or through the previous data it has been seen that they do not take out the money as regularly or in huge amounts and such. So the stable retail deposits, they have the runoff factor of 5%. But if the stable retail deposits, they are enabled with the internet and mobile banking, then they will have the runoff factor of additional 2.5%. That is, in total 7.5% will be the runoff factor for these kind of accounts now. Okay, so stable retail deposits enabled with IMB, enabled with internet and mobile banking, shall have 7.5% of the runoff factor. And less stable deposits enabled with IMB, so less stable deposits, they usually have the runoff factor of 10% plus the let's say less stable deposits are enabled with the internet and mobile banking, then they will have the additional 2.5% of the runoff factor. So in total their runoff factor will be 12.5%. So less stable deposits enabled with IMB shall have runoff factor of 12.5%. I hope this is very much clear for all of you. Now unsecured wholesale funding. So wholesale deposits, they are usually done by the businesses. So there are the retail deposits that are done by the individuals, let's say. Then there are the wholesale deposits that is done by the businesses. Okay, usually the businesses do the wholesale deposits. So unsecured wholesale deposits. Unsecured wholesale deposits means the huge wholesale deposits. Let's say the wholesale deposit is of 10 lakh rupees, but it is secured. DICGC only secures the deposits in the bank account till the limit of 5 lakh. Okay, that means there is the other 5 lakh or the 5 lakh is insured, but the other amount, the rest of the 5 lakh, it is not insured. So there are the unsecured wholesale funding, or there are the unsecured wholesale deposits. They are not secured by any insurance from the DICGC. They are not insured by the DICGC. Okay, or the bank also has no, the banks, if they are under the liquidation, so the wholesale deposits, they do not have any security. Okay, so this is the unsecured wholesale funding. It is provided by non-financial small business customers. Let's say there is the unsecured wholesale deposits. These are the deposits that is done by the non-financial small business customers. Non-financial means let's say kirana store, the vendors, okay, the shoemaker, or let's say the small businesses like the shoes business. Like there are very small shoe manufacturers, right? There is small like crockery manufacturers and such. Okay, so non-financial means it is not in the financial domain and it is a small business. So unsecured wholesale deposits that is given by non-financial small business customers, this shall be treated in accordance with the treatment of retail deposits. Okay, the same rates will follow for the non-financial small business customer. Let's say there is a crockery manufacturer that has a very long-term relationship with the bank, and the crockery manufacturer, past data has shown that the deposits are usually stable. The crockery manufacturer do not take out the money in a very like rampant manner and such. Okay, so crockery manufacturer is a stable non-financial small business customer for the bank. Okay, and the crockery manufacturer has done the stable it is the stable deposits has been done by this crockery manufacturer, so it will have the same rates as applied to the retail deposits. Similarly, let's say there is a shoe manufacturer, a small shoe manufacturer, who has done the deposits with the bank, and it has been seen that the shoe manufacturer takes out the money in a very rampant manner, or whenever the money is deposited, after a few days the money can be taken out. So the shoe manufacturer has less stable deposits in the bank. Okay, so then this data will be followed if there is the enablement of the internet and mobile banking. So unsecured wholesale deposits or unsecured wholesale funding provided by the non-financial small business customers shall be treated in accordance with the treatment of the retail deposits above. So this is the idea. Now coming to the next point, level 1 high quality liquid asset. I have told you about the high quality liquid assets that has to be maintained against the total net cash outflows over the next 30 days, right? So the bank has to maintain the stock of high quality liquid asset against the total net cash outflow over the next 30 days. So it should be equal to 100% or greater than 100%. Okay, this is the liquidity coverage ratio. Now the high quality liquid asset, it is divided into two levels: level 1 high quality liquid asset and level 2 high quality liquid asset. So level 1 high quality liquid asset, this is in the form of cash, including cash reserves in excess of required CRR. So current CRR is 4%. Okay, so current CRR is 4%. So cash, including the cash reserves that is in excess to the required CRR of 4%, so that will be included in the high quality liquid asset. So basically, if the banks have extra cash, so that will be included in the high quality liquid asset. That is level 1 high quality liquid asset. Government securities in excess of the minimum SLR requirement. SLR requirement, the statutory liquidity ratio requirement is 18%. So in the SLR, the banks can keep SLR. In the SLR, this is the reserves that the bank can keep in the form of cash, in the form of gold, or the government securities. So government securities that is in excess of the minimum SLR requirement, so that is under the level 1 high quality liquid asset. Within the mandatory SLR requirement, the government securities, so remember that within the mandatory SLR requirement of 18%, the government securities to the extent that is allowed by the RBI under the Martian Standing Facility. So as you know that under the Martian Standing Facility, the banks can take the loan. The banks can take the loan under the Martian Standing Facility during the liquidity crunch or during the stress situation. So during the liquidity crunch or during the stress situation, the banks can take the loan from the Reserve Bank of India under the Martian Standing Facility. Okay. So in this case, the banks have to provide a collateral to the RBI in the form of government securities, and it is allowed that till a limit, the banks can use the SLR government securities to keep as collateral with the RBI. So MSF is the Martian Standing Facility under which the banks can take the loan from the RBI during the stressful situation, during the liquidity crunch, and the banks have to keep a collateral with the RBI in the form of government securities. And till a limit, the SLR government securities can be used by the bank to keep as collateral with the RBI. And this limit of SLR government securities can be used as high quality liquid asset also. This has been said. So with the mandatory SLR requirement of 18%, government securities to the extent that is allowed by the RBI under the MSF, this is allowed under the high quality liquid asset also. Marketable securities issued or guaranteed by the sovereign governments, by the foreign sovereigns, that is foreign governments, satisfying all the following conditions. That means they are assigned with the 0% of risk weight under the Basel II standardized approach, traded in large, deep, active repo or cash market. That means there is a huge trade that is going on in such government securities or marketable securities issued or guaranteed by the foreign sovereigns. Okay, they are not issued by a bank or financial institution. They are marketable securities issued or guaranteed by the foreign sovereigns, but they should not be issued by bank or financial institution or NBFC, that is any financial entity as such. So this is the idea. So these can be the level 1 high quality liquid asset: cash in excess of the CRR, the government securities in excess of the SLR requirement, the government securities that are in the SLR requirement but they are allowed under the MSF, and the marketable securities issued or guaranteed by the foreign governments, foreign sovereigns, satisfying the condition. That means they have the 0% of risk weight, they are traded in large huge quantities in the market, they are not issued by bank, financial institution and such. Okay, now level 2 assets. Level 2 assets, after the level 1 assets there are the level 2 assets, okay, that include the marketable securities that are guaranteed by the foreign sovereigns, foreign governments, but they have some risk attached, let's say risk attached of 20% and such, or risk attached of 50% or such. Okay, so marketable securities issued or guaranteed by the foreign governments satisfying the following condition, they are assigned at 0% of risk weight under the Basel II standardized approach. So they will come in level 1 high quality liquid asset. In the level 2 assets, there is the level 2A assets that usually are the marketable securities guaranteed by the foreign governments, foreign sovereigns that have a risk weight of 20%, less than 20% or 20%. Okay, so now level 2B of the assets, these are the marketable securities that are guaranteed by the foreign sovereigns that have the risk weight between 20% to 50%. Okay, so this is the basic idea. So these can be included in the stock of liquid assets. So level 2 assets, these can be included in the stock of liquid assets. So basically level 2 assets, they can be included in the high quality liquid asset, okay, comprising level 2A assets or level 2B assets. So there are different examples of 2A asset, 2B asset, but you do not have to go too much in depth. 2A assets also include the corporate bonds other than the bonds of the banks and such, but you do not have to go too much in depth. Basically level 2A assets, just an example I have given, that they include marketable securities that is guaranteed by the foreign sovereign that has the risk weight of 20%. Level 2 assets, they are like, one of the example is that they consist of the marketable securities that is guaranteed by the foreign sovereign that have the risk weight of higher than 20% but lower than 50%. Okay, so just one example I've given you to make you basically understand, okay, that the level 1 assets are better assets as compared to level 2 assets, because in the level 1 assets the marketable securities have 0% of risk weight if they are issued or guaranteed by the foreign sovereign. But here 2A assets have the risk weight of 20%, while 2B assets, they have the risk weight of higher than 20%, lower than 50%. Okay, so these can be included in the high quality liquid assets subject to a requirement that they comprise no more than 40% of the high quality liquid asset. That means in the high quality liquid assets, so basically in the liquidity coverage ratio, against the total net cash outflows over the 30-day time period, the banks have to maintain the high quality liquid asset against the total net cash outflow over the 30 days. So in this high quality liquid asset, 40%, up to 40% can be level 2 assets, and the rest 60% or more should be level 1 assets. This is the basic idea. So level 2 assets can only be up to 40% of the overall stock of high quality liquid asset. So basically so now to understand this point, let's understand that, see, the level 1 high quality liquid asset or level 1 assets, these assets can be included in the stock of liquid capital. That means in the high quality liquid asset, the level 1 assets can be kept without any limit, as also without applying any haircut. So in any of these, in any of the securities, in the government securities, in any of the securities, there is no need to keep any haircut. What is haircut? That we will understand. But in the 2014, so these guidelines, they were released in 2014. Okay, they were released in 2014, and at that time it was said that there is no need to apply any haircut on the level 1 high quality liquid asset, or on the level 1 asset there is no need to apply any haircut on any of the security. But now in 2025 there is a review that has happened of the liquidity coverage ratio guidelines, and on the basis of the review there is a change that has been done. It has been said by the Reserve Bank of India, as per the review and in the final guidelines, that the level 1 high quality liquid asset in the form of government securities shall be valued at an amount not greater than their current market value. That means if the government security, let's say this is the government security, this is a government bond. Okay, I hope you know that through the government security, through the government bond, this is a financial instrument through which government raises the funds from the investors. Okay, so if the government requires the fund, the government let's say has issued this government bond that has a time period of 5 years, and government is raising 10 crore rupees for the 5-year time period, and the government has promised to pay some interest rate on the 6-month basis, on the half yearly basis. Okay, so this is a government security through which the government is raising the fund from the investors. Okay, so now this government security, let's say it has a face value of 10 crore rupees, but right now in the market value of this government security, let's say this government security was released in the previous year, and now the market value of this government security is 9 crore rupees. Okay, this market value of this government security is 9 crore rupees. So first of all, it has been said that the level 1 high quality liquid asset in the form of government securities shall be valued by the bank that is keeping this government security at an amount not greater than their current market value. Even if their face value is 10 crore, 15 crore, but it doesn't matter, the market value has to be noted. Okay, so the government security shall be valued at an amount not greater than their current market value, that is, let's say 9 crore, adjusted for applicable haircut. Now this market value can further fluctuate. There can be further fluctuations that can come in the market value. So you have to take into account the fluctuations also. What if the value further decreases? So there is some fluctuations that have to be taken into account, and for that there is the applicable haircuts. Okay, in line with the margin requirements. So there were the margin requirements. You do not have to remember these numbers. It is not required. It is only to show that there were the margin requirements that were given for the margin standing facility, for the liquidity adjustment facility. So these are the margin requirements, and this much of the haircut has to be applicable for the with the current market value. So if the current market value is 9 crore, so the haircut has to be applicable. Haircut should be taken, okay, for, let's say, for the treasury bills and central government security, central government dated securities, that is of 5 years to 10 years, the margin requirement is 2%. So haircut will be 2%. Okay, so the cut that will be taken will be 2%. That means there is the chances for the market value to decrease by 2%. So this is the idea. I hope this is clear, that level 1 high quality liquid asset, first of all, in the form of government securities, they shall be valued at an amount not greater than the current market value, even if their face value is higher, but only their current market value has to be taken into account and adjusted. It should be adjusted for applicable haircuts. And how much will be the haircut? How much will be the downward fluctuation that we can take into account? So that is as per the margin requirement that was given in 2018, that was given in previous time period. Okay, so this is the idea. So this, let's say, for the government security that we are talking about, we are talking about the government security that is for the period of 5 years. So it has the margin requirement of 2%. That means this will be the haircut, or this will be the fluctuation, downward fluctuation that we will take into account. Okay, so adjusted for applicable haircut in line with the margin requirement under the LAF and the MSF as described in 2018 circular. Okay, so as per this 2018 circular, the margin requirements have been given. Let's say we are talking about the government security. Let's say this is a government security for a 1 year time period, or let's say it is the government security for a 2 year. So let's say we have a government security for a 2 year time period. Okay, and the bank is keeping the government security for the 2 year time period, and the face value was 100 crores, but the market value is 95 crores. So first of all, market value should be taken into account, and the haircut. So for 2 years, government security that is of 2 years, it will have the margin requirement of 1%. It has the margin requirement of 1%. So the haircut that will be taken, or the downward fluctuation that will be taken, will be 1%. Okay, so the market value is undertaken, but negative 1%, like adjustment will be done by negative 1%, that this is the haircut, and then the value should be noted by the bank. I hope this is very much clear now. You do not have to remember the margins. This is just an example to make you understand, and as it was mentioned here, so I showed you the margin requirements. No need to remember, just remember the point. Okay, now coming to last point of the final guidelines. In case a deposit is excluded from LCR computation, for instance a non-callable fixed deposit, try to understand that there is a non-callable fixed deposit. The non-callable fixed deposit, this is a deposit that is fixed, like that the bank has for a fixed time period, that will mature. Let's say this fixed deposit will mature after 1 year. Okay, it is non-callable. Non-callable means that it cannot be withdrawn before the maturity. So let's say that it will mature after 1 year. So in the LCR computation, tell me that if we are taking the total net cash outflows over the next 30 days, so this non-callable fixed deposit, this deposit, will it be included in the LCR calculation? No, it cannot be included in the LCR calculation, because here we are taking only the total net cash outflows that can happen in the next 30 days. Right? So this non-callable fixed deposit, it is the deposit of the depositor, but the depositor cannot withdraw it before the maturity. Within next 30 days, the depositor cannot withdraw it. So that's why the non-callable fixed deposit, they are not included in the LCR computation because they cannot be withdrawn by the depositor before the maturity. This is the idea, okay? But let's say that this non-callable fixed deposit, if it is, let's say the non-callable fixed deposit, if it is kept as a collateral for the loan taken from a bank, okay? Now, if the non-callable fixed deposit, it is kept as a collateral, kept to take a loan from the bank, that means if a non-callable fixed deposit is contractually pledged as collateral to secure a credit facility or loan, such non-callable fixed deposit becomes callable fixed deposit. That means if the loan is not paid back within the time, let's say the loan was taken for a 60 time period, if the loan is not paid back, then the fixed deposit will be used to pay or to cover the loan, okay? So this is the idea, that if the default is happening over the loan, so then this callable fixed deposit or this non-callable fixed deposit that has become the callable fixed deposit will be used, okay? This is the basic idea, that the non-callable fixed deposit, this is usually considered that it cannot be withdrawn before the maturity. But let's say this non-callable fixed deposit is kept as a collateral with a bank to take a loan. And if there is the default, that is, so first of all, this non-callable fixed deposit that is kept as a collateral with the bank to take a loan, this fixed deposit become a callable fixed deposit that can be withdrawn, because if the default happens on the loan, then this collateral will be used, this fixed deposit will be used to pay the bank for the loan. So in case a deposit is is excluded from LCR computation, that means non-callable fixed deposit, because they cannot be withdrawn before the maturity, so they are usually excluded from the LCR computation. But let's say they are contractually pledged as collateral to secure a loan or credit facility, such non-callable fixed deposit, first of all, it becomes the callable fixed deposit, okay? But there are certain conditions. So a very important condition I will tell you, the rest is not very important. The important part I have told you, okay? So basically, the banks generally allow loans against deposit of customers. So let's say you have deposited, let's say non-callable fixed deposit, you have deposited of 1 crore for a 1 year time period. Now you cannot withdraw this money before the maturity at any case, okay? Any general case, you cannot withdraw the money before the maturity of 1 year. Now, if you are keeping this as a collateral, to take a loan, now this non-callable fixed deposit becomes callable fixed deposit for the bank, because if you default in paying the loan, then this non-callable fixed deposit can be used as the callable fixed deposit by the bank, okay, to take the money for the loan payment. This is the idea. So if a deposit is contractually pledged as a collateral to secure a loan granted by the bank, now try to understand this condition, that let's say the loan is not going to mature for 60 days. The loan will mature after 60 days, or the loan has to settle after 60 days. The loan will mature after 60 days, or the loan has to settle after 60 days. So will it be included in the LCR computation, where we are taking the total net cash outflow within 30 days, over the next 30 days? So no, this will not be included in the LCR computation, because the loan is getting settled or matured after 60 days. After 60 days the settlement or the settlement need to happen of the loan. So this fixed deposit will not be withdrawn for a 1 year time period. Even in the case of the loan, the money can only, if the default happens, the money can only be withdrawn, or the money will only be used for the settlement after 60 days. So within 30 days, there will be no outflow that will happen of the money from this fixed deposit. I hope you are able to understand that this non-callable fixed deposit, it cannot be withdrawn by the depositor for a 1 year time period, because this is a non-callable fixed deposit. If it is kept as a collateral with the bank, and if the default happens, but the default will be taken into account after 60 days, the settlement will happen after 60 days. So this money from the fixed deposit will not be taken out over the next 30 days time period. So this is the idea, that even if the callable fixed deposit, even if the non-callable fixed deposit is kept as a collateral with the bank to cover the loan, to take the loan, so, and the loan is not getting matured or settled in the next 30 days, then banks may exclude such pledged deposit from the LCR calculation. Okay. So this is the idea, that even if the non-callable fixed deposit is being kept as a collateral with the bank for the loan, but if the loan is not maturing or it is not getting settled before 30 days, that means, let's say, the maturity or settlement will happen after 60 days, so it is not needed to include in the total net cash outflows over the 30 days, because the settlement will not happen for the 60 days. This is the basic idea. So this is one of the condition. Okay, so we have understood that the in case a deposit is excluded from the LCR computation, but it is contractually pledged as a collateral to secure a loan or the credit facility, then this non-callable fixed deposit will be considered as the callable fixed deposit. Okay, but in case the loan is not getting matured or settled for the next 30 days, then it need not be included in the total net cash outflow. But let's say that the loan will have to be settled within 30 days, or the loan has to be settled within 20 days or such, then the outflow can happen. If the default happens, then the outflow will be required from this non-callable fixed deposit. Okay, so this is the idea. So now coming to the next news article, circulation migration to bank.in domain. So in the statement on developmental and regulatory policies that was released in February 7, 2025 under the head of enhancing trust in financial sector through bank.in and fin.in domains. So it was said that what is happening, that the frauds are increasing. Now there is the SBI website, or there is the SBI. If you want to go to the SBI website, you do not know the actual website domain, right? Or if you want to go to the PNB, there are various banks. How many of the website original domains will you remember? So what was happening, that many of the fraudsters, they were making their own website in the name of, let's say, SBI, PNB, or any other bank. And if you were clicking in these websites that were originated by the fraudsters, and you were making any payments through this fraud websites, then there were the money that were getting taken out from your bank by the fraudsters. So there were a lot of frauds that were getting started due to this. Okay, so there were increased instances of fraud in digital payments. This has become a significant concern. So to combat the same, the Reserve Bank of India has introduced, or is introducing, the bank.in. That is going to be the exclusive internet domain for Indian banks, and it will only be allocated to the Indian banks, the original websites of the Indian banks. Okay, we can understand. So this initiative aims to reduce cybersecurity threats and malicious activities like phishing, and streamline secure financial services and such. So it was said that bank.in, this will become the exclusive internet domain for the Indian banks, and later on fin.in will be introduced as the exclusive domain, as the exclusive internet domain for the other non-bank entities in the financial sector. Okay, so in the statement on developmental and regulatory policies dated February 7, 2025 on enhancing trust in financial sector through bank.in and fin.in domains, it was said that there will be the introduction of exclusive internet domain, that is bank.in, for the banks. So only the banks will be able to use the bank.in, and whenever you see a website of the bank, if it is using the bank.in, then you will understand that, okay, this is the original website. If it is not using the bank.in, let's say there is a website sbionline.psb, so that means this is not the original website, because it does not have the bank.in. Okay, so you will understand that, okay, which is fake website, which is original website of the SBI, or which is the original domain of the SBI, or original link for the SBI. Okay, so the bank.in for the banks will be used to combat the increased instances of fraud in digital payments. This was announced. So this initiative is aimed at strengthening the cybersecurity framework and enhancing the public confidence in digital banking and payment system. Now let's understand that what has happened. So it has now been decided to operationalize the bank.in domain for banks through the Institute for Development and Research in Banking Technology, which has been authorized by National Internet Exchange of India under the Ministry of Electronics and Information Technology to serve as the exclusive registrar for this domain. So the Institute for Development and Research in Banking Technology has become the exclusive registrar for the domain. Okay, so IBRD is the exclusive registrar for the bank.in domain, which means it is responsible for approving and locating the domain names under the bank.in. Okay, so let's say the SBI wants the official domain or the bank.in domain for its website or for itself, so it can get, let's say, whatever the name is, .bankin. So the approval and the allocation of the domain names will be done by the IBRDT. It will verify the eligibility that this is a true bank and the true bank is asking for the domain name. After verifying the eligibility, only the legitimate banks can register these domains. So fraudster will have no chance of registering under this bank.in domain. Maintaining a registry base, the IDRBT will also maintain a registry base of all the domain names under the .bank.in. Okay, or it will also keep the lookout that only the official banks have this domain name. So banks may contact IDRBT at sahyog@idrbt to initiate the registration process. IDBRT shall guide the banks on various aspects related to application process and migration to the new domain. Okay, all banks are advised to commence the migration of their existing domains to the bank.in domain and complete the process at the earliest that they can do, not later than October 31st, 2025. Okay, so this is the idea. So I hope this is clear. Now this is it for today. I will show you the questions that you have to give the answers of. But before that, there is a Perspective 360-degree series that EduTap has brought. Jaskran sir takes this series, and if you want to know the art of writing the answers, if you want to know that how you can write good answers for the questions, so for that this is the descriptive answer writing series that we have brought. This is the Perspective 360-degree series that is on Monday, Wednesday and Friday at 5 p.m. Jaskran sir takes, and he tells you the art of writing the answers, and there are different important points or important reports or schemes on which the sessions are taken, as well as there is also the homework question that is given in this sessions, and below the sessions, below the session in the comment section you can write the answers, and the answers are evaluated by the team. Okay, so this is the idea. Now this is the first question. I hope you will be easily able to answer this question. Try to answer this question. And this is the second question. I hope you will be easily able to answer this question. Okay, so these are the two questions. Try to answer them. So this is it for today. Thank you very much for joining the session, and do give me the right answer of the homework questions. If there is any confusion, do tell me in the comment section below. Thank you everyone.